Should government introduce a financial transaction tax? Hi everyone, today I'd like to discuss one of the most controversial proposals in financial economics. Should government impose a financial taxation tax on the buying and selling of stocks, bonds, and other financial assets? Modern financial markets process trillions of dollars in transactions every day. These markets play a crucial role in allocating capital, financing businesses, and facilitating economic growth. However, the extraordinary speed and volume of contemporary trading have also raised concerns about excessive speculation and financial instability. In response, some economists have proposed a financial transaction tax (FTT), a small tax levied on the purchase and sale of financial assets. Supporters argue that an FTT could discourage short-term speculative trading while having only a limited effect on long-term investment. Advances in financial technology have enabled high-frequency trading (HFT), in which sophisticated algorithms execute thousands of trades within fractions of a second. Although HFT may improve market liquidity, critics argue that it can also amplify market volatility and encourage excessive speculation that contributes little to productive economic activity. Because an FTT slightly increases the cost of each trade, it may reduce trading strategies that depend upon extremely small profit margins and extraordinarily high transaction volumes. Another justification concerns negative externalities. Financial crises often impose enormous social costs through unemployment, business failures, and fiscal burdens associated with government interventions. Individual traders may not fully consider these systemic risks when making investment decisions. Supporters therefore argue that a modest transaction tax could help internalize part of the social cost associated with excessive financial activity. An FTT would also generate public revenue. Government could allocate these funds towards financial regulation, infrastructure, education, or climate policy without significantly increasing taxes on labor income or consumption. Given the immense scale of financial markets, even a very small tax rate could produce substantial fiscal resources. However, critics contend that the policy may generate unintended consequences. One concern is market liquidity. Frequent trading allows buyers and sellers to transact efficiently. If transaction costs increase, fewer market participants may trade, potentially widening bid-ask spreads and making financial markets less efficient. Lower liquidity may actually increase price volatility rather than reduce it. Another challenge concerns international capital mobility. Financial transactions can often be executed across national borders. If only a small number of countries impose an FTT, investors may simply relocate trading activity to jurisdictions with lower transaction costs. This could reduce domestic financial competitiveness while generating less tax revenue than policymakers anticipate. Critics also question whether speculative trading is necessarily harmful. Speculators often contribute to price discovery, helping markets incorporate new information rapidly into asset prices. Restricting speculative activity too aggressively may impair the informational efficiency of financial markets. In my opinion, a carefully designed financial transaction tax deserves serious consideration, but only through broader international coordination. A unilateral tax may simply shift financial activity abroad. Moreover, policymakers should distinguish between productive investment and destabilizing speculation, rather than assuming that all high-frequency trading is socially undesirable. Ultimately, financial markets perform two essential functions. They allocate capital efficiently and facilitate risk sharing. Public policy should preserve these functions while reducing excessive speculation that threatens financial stability. The challenge is finding the appropriate balance between market efficiency and systemic resilience. So here's my question. Should governments impose a financial transaction tax to discourage excessive speculation, or would such a policy ultimately reduce market efficiency and weaken capital formation? I'd love to hear your thoughts. Thanks for listening. See you next time.